Much. And if there's a poster child for the pandemic stock boom and its recent demise, it is, of course, the ARK-K ETF. The ARK Innovation ETF, it peaked at over $150 a share last February. It has since plunged by 70%. The fund's marquee holdings include broken stocks like Zoom, Roku, and UiPath, down 80% from their highs, and TDoc, now down by a similar amount after collapsing more than 40% yesterday after poor guidance in its results. TDoc is the 8th largest holding in Wood's flagship ARK Innovation ETF, and every name in the top 10, with the exception of Tesla, is down more than 30% over the past year. Joining me now is Cathie Wood, the CEO and CIO of ARK-K's owner, ARK Invest. Cathie, welcome. We all give you credit for coming on to talk about why in the world you bought $20 million more of TDoc yesterday, right?
Sure. Hi, Kelly. And yes, I'd much prefer to come out at this time than to come out and be all over media when things are when stocks are soaring, because I think this is our best value add. Yes, TDoc, very, very tough quarter, and that's particularly for investors who are quarter-to-quarter oriented. As you know, we have a 5-year investment time horizon, but as fears about inflation and interest rates have moved up, time horizons in the market have shortened to basically a quarter. And so the analysts picked apart the quarter and zoomed in on the direct-to-consumer business, which did have a shortfall. There's more competition in that space as venture capital is financing some companies who are getting into niche areas. Now, our point of view is that TDoc is becoming the healthcare information backbone of the United States. It serves 16% of Americans are paid users. And whenever we look at S-curves, we are looking for that 15 to 20% range as a trend moves into that market share. That is the beginning of an S-curve. And the story is not direct to consumer for TDoc. Certainly that was a big booster during COVID. The story here is much bigger. It's business to business. What was not mentioned, and no questions about Northwell, the New York or tri-state area hospital system that TDoc has won, took it from another entity. And what was also not mentioned is Amazon's decision to partner with TDoc as opposed to compete with it. The stock had been beaten up regularly over the last year as Amazon said, we're going national, we're going national. And instead, Amazon has capitulated and at least is going to partner for some healthcare services and certainly through Alexa with TDoc.
Sure.
So I think the story here is huge. When you think about healthcare as 20% of the U.S. economy, so a $4 trillion ecosystem, the waste there is at least $400 billion.
Sure.
We would submit most of because this healthcare information system connecting patients, doctors, insurance companies, and hospitals has not been put in place. This is a winner-take-most market, and we feel that yes, short term there was an earnings shortfall. They had to cut estimates. Admit that we're looking 5 years out. We're looking at one of the biggest stories in healthcare, a category killer during the next 5 to 10 years.
What do your analysts think TDoc is worth per share? It is currently trading at 34, and I ask in part because all of the factors you cite, while compelling, get to the heart of ARK's differentiation, which is your research process. TDoc bought Livongo for $18.5 billion and just took a $6.5 billion goodwill write-down. So why should we trust TDoc's business model and some of the choices that they've made? And what does ARK-K think this stock intrinsic value is?
So Livongo was a we don't like growth by acquisition generally, but Livongo was a very important piece of the puzzle for TDoc to acquire. It covers chronic illnesses. And whereas TDoc was much more focused on acute illnesses, emergency room, and so forth. So it needed that recurring revenue base. And the other thing that Livongo brought was a huge amount of data. This is a data story, as all artificial intelligence winner take most opportunities are. And we have two data science organizations coming together, TDoc and Livongo. They brought in Klaus Jensen from Memorial Sloan Kettering to run it. And very interestingly, they just hired a woman from AWS. She led life sciences at AWS, and AWS has the lion's share of the life sciences market. She chose, of all companies out there, to join TDoc. Her background is United Health, J&J, and then AWS, where she helped build out that life sciences business. TDoc is thinking big. You ask us, what is our price target out there? Well, as Simon Barnett, who is one of the most brilliant analysts out there in this space, as he was looking at his model and looking at how far ahead they are on the enterprise side, far ahead relative to our expectations. And remember, enterprise B2B is where we think this story is going to fly. He was adjusting his model, and he said, I can't even throw out this number. We'll haircut it by 50%. But he sees, again, preliminary estimates, one day after this quarter, but again, we've got a long-term point of view, a 10-fold increase. This is like Amazon. Remember, Amazon in the day, it IPO'd at 18 in 1997, went to 118, and then in the crisis, round trip back to 18. Today, it's at 2,500, even after it's dropped today. We see TDoc in the same league as an Amazon. And, we also have experience with controversy. Our first big source of controversy was Bitcoin in 2015, when it was $250. Now it's almost $40,000. Tesla, we were fighting that battle for a very long time. And it went from $30 in 30 on the split stock. I get a bit mixed up, to where it is today, $1,000. So these are big ideas. I think we're one of the few organizations, financial organizations in the world focused solely on disruptive innovation. This is our bread and butter. And because most of our stocks are not in broad-based benchmarks, most analysts don't feel the need to cover them that closely.
Sure.
So we are doing something. We are fulfilling, we believe, an unmet need, helping investors and advisors to diversify portfolios and incorporate disruptive innovation that is going to unearth the traditional world order. It's going to disrupt it. And so we're a good diversifier and a hedge against the creative destruction that disruptive innovation is going to.
To be clear, you're saying that at $35 today, your analysts think TDoc is worth $350 a share potentially. So when you say there's a 5-year time horizon, those are the kinds of values that you're pitching to the investors who are kind of sticking around to still see this story out. Let me ask you something. Have you ever thought that there was an investment, a holding that you overpaid for? A mistake, a research mistake, perhaps, that, was later borne out by an earnings power that didn't match up to expectations? Or has every single holding, in your opinion, been either a success or an unproven success where investors just have to wait a few more years to see better returns?
Yeah, I think a lot of people understand when they hear us talk with such conviction about our stocks, and the conviction is born out of research. They think that conviction translates into perhaps arrogance or hubris, that we can never be wrong. That is not true. In fact, if we make mistakes all the time. If you don't take risk, you're not going to be able to generate the returns. We have taken, since last February, the number of stocks in our flagship portfolio, ARKK, peaked at 58 and is now 35. So there are 23 names that we took out of the portfolio saying, you know what? We're not as confident in our assumptions, or we don't like this management turnover. Management changes we watch like a hawk, and that's why I mentioned those on TeleDoc. Mm-hmm. We're very impressed with the talent they're attracting. So no, we're going to be wrong. We are. I'm sure we have mistakes in the portfolio now, and many people would say, "Well, look at the stock price. It's for ARKK. It's been decimated. It's been decimated, and it's treating our stocks and our portfolios as though it is 1999, when there were a lot of companies that were founded that actually failed. That they were chasing a dream that is becoming a reality right now. And we are investing in that reality, even though many investors, unlike the late 90s, are running away from innovation, running into their benchmarks, and selling our stocks.
Final question, you mentioned management. Do you think Elon Musk is done selling his Tesla shares in order to fund the buyout of Twitter? You've been continually, obviously, bullish on Tesla, keeping it within that 10% holding range. More bearish on Twitter, as I understand it. So can you just give us your updated thoughts on both stocks, especially in light of the selling pressure on Tesla that's resulted from this?
Yes, and we post our trades at the end of every day, and you'll see that we have been selling down Tesla, but it's still our largest position, 9.5% in the portfolio. When we see Tesla down, 20% from its high, and we see some of our other stocks down 60, 70%. Now there's more optimism with Tesla. It's in the indexes now, so it gets more support. We're going to make that kind of trade, but our confidence in Tesla.
What kind of trade? You mean you're selling out of it because of the price action in some of the smaller, more beaten down stocks?
Yeah. So portfolio management means if a stock is, especially over the past year and a half, Tesla has been a moonshot, and our confidence is very high, but it is maintained its valuation relative to some of the other names, in which our confidence also has increased. So Tesla, we have not lost any confidence in Tesla at all, and understand that Elon Musk is diversifying, as he should. He has an incredible amount of his net worth in Tesla, and he feels very strongly about Twitter. So, and we're very interested in what he's going to do with Twitter. We just had a brainstorm about it, and we think he could do some magnificent things with it as a private company, reorganizing the model in some way. And opening up the algorithm. So fascinated by that. In terms of Twitter, what's ironic here, our greatest fear for our portfolio right now is that our names will be taken out. They'll be acquired. They are selling at bargain basement prices. If you give us a 5-year investment time horizon, we will maintain that they are deep value names. So our fear is that they're going to be taken out. Now, Elon is taking out Twitter personally, which is even more interesting. We wouldn't have expected that. But Elon has done great things for the transportation space, for space travel itself, or the space interconnectivity. Yeah. And we would place a high degree of confidence that he'll do very well with Twitter.
We all have to go, but so to be clear, are you done selling your Tesla position at this point?
Well, I can never say never. If Tesla went up 30% and some of our other stocks went down 20%, that would be a natural trade for us to make. But it would still probably stay as the largest name in the portfolio.
Cathie Wood, thank you for your time today. We appreciate it very, very much. Cathie Wood is the CEO and CIO of ARK Invest. Still ahead on the exchange, we'll talk about how many rate hikes are priced into the market and if the Fed would be any closer to a full point hike. Our next guest is calling for 4 half-point hikes, and that was even before the hot inflation readings this week. We will dig into that. And as we head to break, here's a look at your markets just off session lows. The Dow down 528, the Nasdaq again the worst performer, down 2.4%, on track for its worst month since October 2008. We're back in a moment.